The stores open at 6:47 in the morning. Not 7, not officially. But the cooler needs restocking and the bread delivery arrives before the signage changes and someone has to be there for that. That someone is Manny. Has been for 11 years. The family calls it Manny's even though the sign says Valencia Grocery and Market. The city knows it as the place on Del Mar that never runs out of hot sauce. Here's the thing that changes everything. It is not the day revenue crosses $40,000 in a single month. It is not the day they hire a third employee. It is one Tuesday afternoon when Manny's daughter, Rosa, who handles the QuickBooks when she is not working her actual job in hospital administration, prints out a 12-month summary and puts it on the counter next to his coffee. She points to the number at the bottom. Then she points to what is above it. She says, "Here's what you made, and here's what you actually controlled." Manny looks at both numbers for a long time. The profit is real. But the control system, the part that determines when cash comes in, how fast inventory turns, what the vendor terms say, when payroll hits, what the margin on each category actually is, that is the asset. The profit is the output. The system is the machine. Once you see the difference, you cannot unsee it. That is the moment this stops being a job Manny owns and starts becoming a business. Level 1 is what most people recognize. One location. Owner-operator. Manny is the store. He opens it, closes it, orders inventory, handles difficult customers, catches the employee who is letting friends walk out with energy drinks. Everything runs through him. If he is sick, the store runs slower. If he takes a Saturday off, something goes wrong. The revenue is real. The enterprise is fragile. The legal structure at level 1 is often a sole proprietorship or a loosely formed LLC that no one has actually read the operating agreement for. Taxes are filed once a year in a cardboard box handed to someone who charges $400 and calls it done. Level 2 is when the bottleneck becomes visible and painful enough to address. A second location is considered. Maybe a third employee is already on payroll. The QuickBooks file is either very organized or completely broken, and there is no in-between. The owner is still the decision point for everything, but now the decisions are multiplying and the owner is not. The move from level 2 to level 3 is where structure either gets built deliberately or the whole thing starts leaking. A multi-location operator is not just a busier version of a single location owner. It is a different entity entirely. It requires cash flow controls that function when the owner is not present. It requires someone in the building who knows what gross margin on beverages looks like this week compared to last week. It requires that payroll not be a surprise. The entity setup question arrives early and most families get it wrong by ignoring it. A sole proprietorship means Manny's personal bank account and the store's bank account are the same conversation. His house is on the table for every vendor dispute and every slip and fall that the insurance does not fully cover. An LLC adds a layer. It is not impenetrable, but it is a line. A separate tax ID, a separate account. The beginning of a paper trail that matters enormously later when the family wants to add a second owner, bring in a sibling, or apply for an SBA loan without creating chaos. The bookkeeping discipline is not glamorous. It is also not optional. Accounts payable, accounts receivable, payroll processed through an actual payroll provider instead of cash envelopes on Friday afternoon. Bank reconciliations monthly, not annually. The cost of this discipline, a payroll service, a bookkeeper at 15 to 20 hours a month, a CPA who does more than file the return and disappear, it starts to feel like overhead. It is not overhead. It is the instrumentation panel. You do not resent the dashboard on the plane. You need it to know if you are flying level. The family dynamics arrive at the same time as the structure questions, and they are harder. Manny's nephew Marcus works the counter Tuesday through Saturday. He is reliable, mostly. His compensation is informal, partly in cash, partly in free merchandise, and partly in the understanding that he is family and family helps family. This arrangement works until it does not. It stops working the moment Rosa tries to reconcile the books and cannot account for the cost of goods in a way that reflects what is actually in the register. It stops working the moment Marcus feels underpaid and overworked and says something at Thanksgiving that everyone remembers for 3 years. Formalizing family roles is not a bureaucratic exercise. It is the thing that prevents the business from becoming the reason the family stops speaking. Who works the counter gets a W-2 and a job description. Who runs the books has a specific scope and a specific rate of compensation, even if that rate is below market because of equity upside or because it is part of a longer plan. Perks get written down. Use of the store vehicle, employee discount, hours that flex around school schedules. These things exist either as informal promises or as documented terms, and the difference between those two formats shows up at the worst possible moment. The reinvestment loop is where the machine quality of the business either develops or fails to develop. Inventory turns are a number. The number means something. If Valencia Grocery and Market turns its beverage inventory every 9 days and the average for comparable stores is 14, that is a capital efficiency advantage. That cash is not sitting on a shelf, it is moving. Vendor terms matter in the same way. Net 30 terms from the primary distributor means Manny has 30 days between taking possession of goods and writing the check. That float is working capital. Negotiating. Net 45 is not a negotiation about 30 days. It is a negotiation about how much cash he can deploy into the second location without needing a line of credit to bridge the gap. The second location does not get funded with a startup loan if the first location is run correctly. It gets funded with operating cash flow from a machine that produces predictable margin at predictable intervals. That is boring. That is also the entire point. The debt reality at this scale is specific and worth saying plainly. The bank relationship matters more than the rate on any individual loan. When Valencia Grocery applies for a small business loan to fund the second location's build-out, the bank officer is not looking at a credit score in isolation. He is looking at 2 years of organized financial statements, a demonstrated payroll history, a current business account that reflects actual cash flows. If those things exist, the conversation happens. If they do not, the conversation becomes a personal loan with Manny's house as collateral. Personal guarantees at this scale are nearly unavoidable. The bank will ask for them. Manny will sign them. The risk is real. The cross-collateralization risk, where a loan on location 2 is secured against the assets of location 1, is also real. A bad month at the second location does not stay in the second location if the paperwork says otherwise. The first failure modes are not dramatic. They are quiet. Commingling money, the personal debit card used for the supply run, the store account used to cover the mortgage gap in a slow month, each of those transactions is a small fire. Informal family promises made in good faith at a kitchen table that no one wrote down and everyone remembers differently. Underinsurance on a lease build-out that costs $40,000 to repair after a pipe fails. The founder bottleneck, Manny on vacation in Florida while the manager at location 2 cannot authorize a vendor substitution and loses a weekend of revenue on a product that was out of stock. None of these are fatal at level 1. Every one of them is potentially fatal at level 3. The machine does not forgive informal operating procedures the way a single counter with a single owner does. Rosa puts the spreadsheet away. Manny finishes his coffee. He asks her what it would cost to do this correctly. She has already run the numbers. Rosa's numbers say 3 locations are possible by year 5. Manny reads them twice. Then he asks the question that changes the shape of everything. He asks whether they should be 3 locations of the same business or 3 businesses that happen to be related. The difference is not semantic. It is structural. And the answer determines who controls what, who gets paid from where, and whether this thing survives the moment Manny stops being the person in the room. Level 4 is where a family operator stops running locations and starts running a group. The distinction matters because the management task changes entirely. You are no longer managing a store. You are managing a system that manages stores. That requires a layer of operations between the founder and the counter. A general manager at each location with real authority and real accountability. Weekly numbers reviewed by someone who was not present at the register. A profit and loss by location, not just a combined total that hides which site is carrying which. At level 4, Manny is no longer the best person to solve the problem at register 2 on a Tuesday. He is the worst person for that job. His time is now worth more in the room where the lease for location 4 gets negotiated. Building that management layer is painful in the specific way that all power transfers are painful. The person who built the system knows every exception. Every vendor relationship has a history. Every regular customer has a name. Delegating into that knowledge base feels like giving away something that cannot be replicated. That feeling is accurate. What replaces it is a documented operating procedure, a trained manager, and an accountability structure that does not depend on institutional memory living inside one person's head. Repeatable operations are not a manual on a shelf. They are the answer to the question of what happens when the area manager is unavailable and location 2 gets a surprise health inspection. If the answer is call Manny, the system is not built yet. If the answer is the manager opens a compliance folder and runs a checklist, the system exists. The ownership machinery upgrades come in parallel with the management upgrade, and they are not optional. A single LLC with one owner and one operating agreement was correct for level 1. It is wrong for level 4. The entity structure at this stage begins to separate what the business does from what the business owns. This is the Opco and propco conversation, and it is one of the most durable structural decisions a family operating group can make. The operating company runs the stores. It employs the staff, holds the vendor contracts, collects the revenue, pays the bills. The property company owns the real estate. If the family purchases the building where location 2 operates, that building sits in a separate entity. The operating company pays rent to the property company. That lease is not a formality. It is a control instrument. It routes cash from operations into an asset holding entity that is harder to pierce in a lawsuit, harder to commingle in a dispute, and more clearly valued when the family eventually needs to bring in outside capital or transition ownership to the next generation. The internal lease also disciplines the operating company. When location 2 pays rent at market rate to the propco every month, the operating margins at that location reflect real economics. There is no hidden subsidy from owned real estate that makes a marginal operator look profitable. The numbers tell the truth. That matters when you are deciding whether to open a 4th location or close a 2nd one. Real estate changes the calculus for the entire family group because it creates a second compounding asset that operates on a different cycle than retail margin. The operating company produces cash flow. The property company accumulates equity and appreciates at its own rate. They are different instruments. Holding them in different entities is not administrative overhead. It is portfolio construction. The cap table becomes a real document at this stage. Multiple family members may now have stakes. Rosa has been running the books for 4 years. Manny's son Daniel has been managing location 2. His daughter Sophia has stayed entirely out of the business but holds a share that Manny put in her name during a tax planning conversation in year 3 that no one fully explained to her at the time. These are 3 different relationships to the business, and they cannot be expressed by a single class of equity that gives everyone the same vote and the same distribution, right? Multiple classes of equity exist to reflect this reality. Class A carries voting rights and is concentrated in whoever is running the operating group. Class B carries economic rights without governance control. Buy-sell agreements determine what happens when a family member wants out, dies, or becomes incapacitated. Without a buy-sell, Sophia's share goes to her spouse in a divorce or to her estate, and now Manny's business partner is someone he has never done business with. The buy-sell is not pessimistic. It is the document that makes the group survivable across events that happen in real families. Governance at this level is not a formality for a business with 3 locations and 8 employees. It is the mechanism that prevents a sibling conversation from happening at Thanksgiving instead of in a boardroom. Family meetings have a different purpose than operating meetings. The operating meeting runs the business. The family meeting addresses ownership questions, compensation policy, whether the 3rd-generation cousins can expect employment, whether distributions get reinvested or taken out. These are ownership questions, and they need a separate forum. The employment and ownership distinction is the one most family groups handle worst. Daniel runs location 2. He is an employee of the operating company. He is also an equity holder. Those are 2 separate relationships. His compensation as an employee should reflect the market rate for his role. His distributions as an equity holder reflect his ownership percentage and the distribution policy the group has agreed on. When those 2 things are conflated, Daniel starts to feel that his labor entitles him to a larger share, and Sophia starts to feel that her ownership entitles her to employment she has not earned. Both of those feelings are predictable, and both of them corrode the group from the inside if there is no documented framework that separates the roles. The cousin employment problem arrives before most families expect it. Marcus's son is 18 and needs a job. The store is there. The expectation forms before anyone has articulated a policy. A family employment policy is a short document with durable consequences. It states what qualifications are required, what the compensation structure is, whether family members are supervised by non-family managers, and what the performance evaluation process looks like. Families who have this document have a hard conversation once. Families who don't have it have a harder conversation every 2 years, forever. The failure modes in the middle of this transition are not dramatic, they are slow and structural. A loan that Manny made to Daniel to cover his personal mortgage in a slow quarter gets recorded as an owner, draw in one set of books and nowhere in another. The bank discovers it during due diligence for a commercial line of credit. The clean financing terms disappear. The hidden loan was not malicious, it was informal. The informality was a problem. 3 entities now. More filings, more overhead, a higher monthly accounting cost. Also, cleaner books, better financing terms, real asset separation, and an ownership structure that can survive a disagreement between Rosa and Daniel without taking the whole group down with it. Manny does not run the counter anymore. He is in the room where the decisions about the room happen. That is either a loss or a graduation. He is still deciding which. By year 12, the operating group has 7 locations, 2 property entities, a management company that charges a fee to each operating company, and a family that has not sat in the same room without a lawyer present since the second refinancing. This is not dysfunction. This is scale doing what scale does. It creates complexity that the original structure was never designed to hold. At some point, the structure has to change again, or the weight of the thing breaks the container. The holding company is that change. The holdco sits above every operating entity and every property entity in the organizational chart. It owns them. It does not run them. The distinction is the entire point. The holding company is a capital allocation engine. Cash flows up from the operating companies in the form of management fees, dividends, and intercompany loans. The holdco decides where it goes next. Into a new acquisition, into real estate, into a reserve account, into a distribution to the family. That decision, made once at the top, is worth more than any individual operational improvement made at any single location. Standardized reporting is not a nice to have at this stage. It is the instrument panel. Every operating company produces the same format, same chart of accounts, same reporting cadence, same margin definitions. When the numbers arrive at the holdco level, they are comparable across entities because they were built the same way. Without that, the CFO is translating between 4 different accounting interpretations every quarter. And the capital allocation decisions are made on inputs that do not mean the same thing twice. The acquisition system develops because organic growth eventually hits a ceiling that acquisition crosses more efficiently. A family operating group that has demonstrated it can run boring cash flow businesses, food service, commercial laundry, building maintenance, light manufacturing, becomes a natural buyer of more boring cash flow businesses. These are not glamorous targets. They are not venture investments. They are companies with predictable EBITDA, owner-operators who are tired, and no obvious institutional buyer. The holdco is the obvious buyer because it brings operating infrastructure. The seller does not have to rebuild from scratch. Deal sourcing at this level is mostly relationship driven and mostly slow. Brokers bring marketed deals with full information packages and full price expectations. The better transactions come from a regional accountant who knows a client who is thinking about retirement in 3 years and has not told anyone yet. Diligence on a small acquisition is not glamorous either. It is reviewing 5 years of tax returns, understanding why the second year dipped, confirming that the key customer relationship belongs to the business and not to the owner personally, and modeling the earnout so that the seller stays engaged through the transition without the earnout becoming a litigation event 18 months later. Earnouts misalign constantly. The ones that work have specific, measurable triggers and a clear dispute resolution process written in before the deal closes. The ones that fail have language that seemed reasonable to both sides at signing and means something different to both sides when the performance period ends. Integration is the part that most acquirers underestimate. Buying the business is the easy part. Installing the reporting format, transitioning the banking relationship, converting the payroll system, and managing the acquired employees who are watching to see whether the new ownership respects what they built, that takes 18 months minimum and dedicated management attention that has to come from somewhere. If the holdco does not have a designated integration function, every acquisition competes with every operating company for the same management bandwidth and something suffers. The capital structure at the top of a billion-dollar holding company is not a single bank line. It is a layered instrument. Senior bank debt from a regional or national lender with covenant discipline that the family has learned to treat as an operating constraint rather than a nuisance. Private credit filling the layer that the bank will not touch, typically more expensive, typically more flexible on structure. As the group grows and the track record lengthens, personal guarantees fade. The founder who signed personally for a $400,000 commercial real estate loan in year 3 is not signing personally for a $40 million credit facility in year 15 million credit facility in year 15. The entity guarantee replaces the personal guarantee when the entity itself has demonstrable cash flow coverage. That transition is not automatic. It is negotiated and it requires audited financials and a CFO who can sit across the table from a lender and defend the numbers without a lawyer doing the talking. Ring fencing risk at this scale means that a bad outcome in one operating company does not cascade into the property portfolio or the holdco treasury. Separate entities with clean capitalization and no cross-collateralization where it can be avoided. The structure that felt like administrative overhead at level 4 is the firewall at level 9. Real estate compounds on its own cycle. The property portfolio that began with one building under one operating location becomes a collection of assets refinanced on different schedules, generating internal rents that create predictable holdco cash flow regardless of how the operating companies perform in any given quarter. The refinancing cycle is a liquidity planning tool. When a property has appreciated and rates are favorable, a cash-out refinance recapitalizes the holdco without a sale event and without a taxable gain. The proceeds deploy into the next acquisition or sit in the reserve. Liquidity planning at this level is a 12-month rolling model updated monthly. Surprises are not eliminated. They are reduced to a size the entity can absorb. Succession at the holding company level is not a conversation. It is an operating plan with a timeline, a competency filter, and a legal structure that separates control from economics in durable ways. Voting trusts and founder shares allow the senior generation to transfer economic value to the next generation while retaining governance authority through a transition period that is measured in years, not quarters. The competency filter is a document the family resists writing and the one that does the most work. It defines what qualifications, what demonstrated performance, and what external validation is required before a family member holds an operating role versus a board seat versus passive equity. Without it, the third generation arrives and the question of who leads the holdco is resolved by whoever argues longest at the table with the most emotional leverage. With it, the answer exists before the question becomes urgent. Estate pressure is constant at this level. The holding company that has crossed $1 billion in enterprise value has a gift and estate tax problem that compounds annually. Grantor retained annuity trusts, family limited partnerships, valuation discounts on minority interests, charitable structures. These are not aggressive maneuvers. They are the standard infrastructure of every family office operating at this scale. The families that plan them at 60 have options. The families that encounter them at 80 have fewer. The human cost of elite infrastructure is not tax or legal fees. It is governance becoming a lifestyle. Board meetings, family council meetings, annual retreats where the agenda covers both the acquisition pipeline and whether the rising generation feels heard. Privacy that is structural, not just careful. A family whose net worth is public information in county filings and commercial databases, and whose employees, advisors, and vendors all hold pieces of the picture. Sibling politics that used to resolve over dinner now resolve through a committee process because the stakes are large enough that informal resolution carries legal risk. The dividend versus growth conflict is permanent at this level. The senior generation built the machine and would like it to produce income. The rising generation is running it and would like to reinvest for a larger exit. Neither position is wrong. Both positions are structural, and they will not resolve through goodwill alone. The governance document that addresses distribution policy in advance is the one that prevents the conflict from becoming a board removal vote. Here's the checklist that runs across every tier in this entire ladder. At each level, there are 3 upgrades that define the transition. Systems, moving from informal to documented, from verbal to written, from one person's memory to a process that survives their absence. Entity separation, moving from a single operating entity to a structure that isolates risk, builds asset portfolios, and creates clean capital flows between layers. Governance, moving from founder decision to documented policy, from family dynamics to structured forums, from control by presence to control by design. The corner store that became a machine, that became a group, that became a holding company did not change its nature at any of those transitions. It was always an engine that converted family labor and capital into compounding assets. The structure just got more precise about how that conversion happened and who controlled what at each stage. Drop a comment with the level you are currently operating at and what structure, what financing question, what governance challenge you want broken down next. That is the map. The next video is wherever that answer points.